Hey folks, Rajesh Patel here with Red Acre Investments. Welcome to the Q3 2013 Biotech Earnings Preview. Q3 earnings for the biotech sector kick off this week with 5 of the top 10 names in the IBB reporting. Next week, 4 more names report, and the final name in the top 10 reports on November 4th. Now, once again, the reason we focus on the top 10 names in the IBB is because they make up 60% by market cap of the NASDAQ Biotechnology Index, and therefore, they're fairly representative of the biotech sector as a whole. Now, in the blog post below this video, you can read where sell-side consensus is for both EPS and revenue. I'm not going to go through and list that right now. Instead, what I want to talk about is where we are in the sector in general compared to where we have been historically. Now remember, back in February, the IBB was hitting all-time highs. So the IBB, of course, is the iShares Biotechnology Exchange Traded Fund. It's an ETF that you can buy and sell, and it tracks the NASDAQ Biotechnology Index. So that means the NASDAQ Biotech Index was hitting new all-time highs in late February. And then we had a massive correction from March through the middle of April. The biotech sector pulled back by quite a bit. We went from $275 a share in the IBB down to below $230 a share in the IBB. So that was a pretty huge correction that we saw. And when Q1 earnings rolled around, the IBB was trading right at around $230 a share. So perfection was not priced in. Fear was the overriding emotion. It turns out that Q1 wasn't that bad. A lot of the companies had a good Q1, only a couple of them stumbled, and confidence was largely restored. We saw the IBB come roaring back between Q1 and Q2. When Q2 earnings came around, the IBB was trading at $255 a share, and at that time we argued that the sector was priced more for perfection, meaning that not too many of the top 10 could come in and have poor quarters or miss consensus estimates, otherwise we're going back down. Well, it turns out that the top 10 in the IBB had an amazing quarter in Q2. A lot of the names smashed consensus estimates. A lot of the companies raised their full year guidance for both EPS and revenues. And once again, all was well in biotech, and between Q2 and now, the IBB once again hit new all-time highs. In the middle of September, the IBB traded almost to $280 per share, but then we saw another pullback, and right now the IBB is at $265 after going down as low as $250 a share. Now that pullback in September was not biotech specific. The Q1 pullback was biotech specific, but this time around, take a look at this chart and you can see that the Dow Jones, the NASDAQ Composite, the S&P 500, and the IBB all pulled back at around the same time beginning in the third week of September. And in fact, all of the major indices, the Dow Jones, the S&P, and the NASDAQ Composite, all traded below their 200-day moving averages, whereas the IBB traded down to the 200-day moving average and then bounced off from there. And in fact, even in that pullback from February to April, the 200-day moving average acted as a good support point for the IBB. So that's a point to keep in mind. When you see the IBB trading at around the 200-day moving average, look for that as a support point. It's probably a good entry point if you want to go long the IBB. Now let's talk about some of the companies in the top 10 and get into some company-specific commentary. And let's start with Gilead. Of course, Gilead is a bellwether of the biotech industry. They're having the best drug launch in history with Sovaldi, but they're about to surpass that with their newly approved hepatitis C regimen, Harvoni, which is a combination of the same drug in Sovaldi with another drug, ledipasvir. And for genotype 1 patients, which make up about 70% of the patients in the United States, Harvoni is an all-oral, ribavirin-free regimen that has cure rates better than 90% over 12 weeks. And in fact, for 45% of the patients that are less sick, they have low viral loads and are treatment naive, Harvoni can cure them within 8 weeks of treatment. Now, a 12-week course of Harvoni is priced at just under $95,000. That means the 8-week course of treatment costs about $63,000. And if the patient numbers come in at the estimated rates of 45% for 8 weeks of treatment and 55% for 12 weeks of treatment, Harvoni should be bringing in revenues of about $80,000 per patient treated on average. Now, a lot of people got nervous right after the Harvoni approval. First of all, the approval was largely expected. In fact, I asked my dog Fido to bark once if he thought approval and bark twice if he thought a delay or rejection, and sure enough, he only barked once. Of course, I'm kidding, I don't actually have a dog, but it just goes to show everyone expected Harvoni to be approved, and therefore there really wasn't any upside in the stock because of the approval itself. The reason for the pullback is the general market pullback that I just mentioned, as well as some company-specific information. There was some changes to the Irish tax laws, and it's a little bit unclear how much of a hit Gilead is going to take. Gilead hasn't really provided some clarity on that yet. So in the Q3 call, look for some clarity about how the Irish tax law changes are going to affect Gilead this year and in the future years, and that's going to affect everybody's financial models. As well, Johnson & Johnson made some comments in their Q3 call saying that they're going to try to make Olysio as competitive as possible in hepatitis C. You know what? They've already lost that race. Olysio is not going to be competitive to Harvoni, and investors that are worried about that really should not be worrying about that issue. What they should be paying attention to is what AbbVie is doing. Now, AbbVie has an all-oral hepatitis C regimen that's going to get approved in December, but as soon as Harvoni got approved, AbbVie decided to get proactive and preemptive and started a direct-to-consumer, non-branded advertising campaign. Basically, they're talking about hepatitis C, the disease condition, directing potential patients to a website where they give information, as well as invite patients to create a treatment action plan. And of course, when you create a treatment action plan, you have to create a username and password and give a lot of personal information, including the status of your disease. So AbbVie has all of this information on these potential patients. It's a lead generation website, and it's a smart move on the part of AbbVie, knowing that Harvoni is launching and has a couple of months head start. Now, what we think is going to happen is that AbbVie is going to come in and price probably at around $80,000 for 12 weeks of their hepatitis C regimen. That would be the smart thing to do. They don't need a price at $63,000, which is the 8-week price for Harvoni. But if they price the same as the blended price for Gilead, they have an advantage in the treatment experienced patients. For treatment experienced patients, especially the cirrhotic patients, AbbVie's regimen in their clinical trials showed slightly better cure rates than Gilead's did in their own clinical trials. Now, of course, the big caveat is you can't always compare across clinical trials. You shouldn't do that, but everybody does it anyway. The sales reps are definitely going to do that when they detail the doctors, and therefore, if AbbVie prices at $80,000, what they can argue is that, look, for the sicker patients, the treatment experienced patients, and especially the cirrhotic patients, our regimen has better cure rates, and it's actually cheaper than 12 weeks of Harvoni. That would be the smart thing to do, and that's what we think will happen. Of course, we won't know exactly what happens until after the approval because AbbVie's not going to talk about pricing until then. The early signals are that they don't feel the need to discount. That's what AbbVie has said all along, and it doesn't make sense for them to discount in this market. Now, the other things to pay attention to with Gilead are, what are they going to do with all of this cash? Investors love to speculate about a big transformative M&A transaction, but if you listen to what management is saying, a transformative acquisition probably is not in the cards this year or next year. They just don't see the need to do it right now. They have a very aggressive share repurchase program. They might have bought up to $1.7 billion of their own stock as of the end of Q3, and they have another $5 billion repurchase program over the next 3 years that they could employ. So every time that investors get nervous and start selling off Gilead, guess what? Gilead is a ready and willing buyer, and that puts a good backstop on the stock. Anytime Gilead goes below $100 a share, it's probably a buy. Now let's talk about Vertex Pharmaceuticals. Vertex, of course, has some great data for the combination of Kalydeco and VX-809 in their traffic and transport phase 3 studies, which reported just before Q2 earnings. And they have guided that they will file an NDA for that combination in Q4. So we don't know exactly when in Q4 they're going to file, but if they get a 6-month priority review, then as early as sometime in Q2, Vertex could be on the market with a combination of Kalydeco plus VX-809. That opens up about 28,000 patients worldwide that Vertex could treat. That's a huge boost in the number of patients that they could treat, and that's what the main story is at Vertex. It's a non-binary biotech growth story. That's exactly what they've been telling investors as they've been meeting with the buy side, and the message seems to be resonating. Now, of course, Vertex has, between now and the time that they report their Q3 earnings, an advisory committee meeting for the R117H mutation for just Kalydeco. They did a clinical trial for ages 6 and above. That trial missed its primary endpoint for the entire trial population, but Vertex did some subpopulation analyses and said, hey, for adult patients 18 and above, we actually see a benefit. Now, that was actually the bulk of the trial population. 50 out of the 69 patients were 18 and above, and they showed a statistically significant benefit. In the pre-NDA meeting, the FDA said, well, that's interesting, but that wasn't a primary or secondary endpoint, so we consider that finding kind of exploratory. Would you please go back and do another study? It would be a less favorable alternative for you to submit the sNDA. What did Vertex do? They went ahead and submitted the sNDA anyway. This is probably a calculated move on Vertex's part. First of all, the doctors that make up the advisory committee, if they're treating cystic fibrosis patients, they already are familiar with Kalydeco and the benefits that it could provide. And they may be thinking that, you know what, if we get a positive vote from the advisory committee, we're probably going to get approved, and that gives us an incremental boost in revenue. And if not, we're going to get the Kalydeco and VX-809 combination approved anyway, and that's going to be a huge bump in revenues. We can go back and do this trial later and get that extra bump in revenue from the R117H population. So by the time Q3 earnings come around for Vertex, we will know the outcome of that advisory committee meeting. Vertex, again, it's a non-binary biotech growth story. Anytime the stock is under $100, it's probably interesting as a buy point. Next year, you should see the company becoming profitable, and if not next year, you definitely will see profitability in 2016. Right now, the sell side is a little bit scattered on what's going to happen next year. Some people are predicting a loss of almost $2 a share, and some people are predicting a profit of $1.87 a share. So there's a wide range. That range is going to tighten up as we get closer to 2015. Vertex is going to give better guidance, and as soon as we know when the NDA, when the PDUFA date is for Kalydeco plus VX-809, everybody will be able to adjust their models for how much revenue Vertex could achieve in 2015. And that'll be the determinant of whether 2015 ends up being the year that they hit profitability or not. So that's what's going on with the biotech sector as we head into Q3 earnings. Now, if you're watching this video on redacre.com, in the blog post below the video, we're giving you a chance to download our October commentary from Redacre Premium. Every month at Redacre Premium, in addition to providing the best analysis of biotech binary events, we also provide a broader market commentary. It's part of our way of helping our members stay ahead of the curve. This month, the analysis is really interesting because what we looked at was how small caps versus large caps have performed in 2014, and then we did a deeper dive into the historical performance of small caps versus large caps over a longer period of time. So if you want to know how small caps are doing versus large caps this year, and whether or not this year is the norm or an exception to the norm, download that market commentary. Thanks for watching the video, and I'll see you next time.